Our first objective was to become similar to Nike, a company whose brand is recognized all over the market, with high margins and price higher than average of the market. When we started the game, we had immediately thought to opt for a strategy of differentiation rather than one of cost advantage. We were very focused on the quality. We've tried to have the best quality of the market during all the game by investing more and more year after year. Another good decision which helped us a lot was to invest from the beginning. We thought that the sooner we invested in a new field, the sooner we'll cover our investment. That was a good point because this new field built in Europe helped us to stay competitive and to keep increasing our market share. We trusted in our strategy. We've tried to focus on our directive line, adapting every year to the market to be able to perform better. To perform and to try to surpass our main concurrent, we started a policy of maintaining price for the moment. We've increased our popularity by advertising and by recruiting stars. And we've increased our productivity in order to increase our margins.
In this slide, you can look at our results. So you can see that in year 14 we had a financial disaster. But later we'll explain you how we have been able to catch up or delay, and Kamal will explain you how we think that we can increase our earning per share and return on equity at such level. So now I will let Manon to talk about the competitive strategy.
We thought to make decisions consistent with the strategy developed. Our competitive advantage should be quality, which we have increased over the years to be above those offered by other companies. This differentiation aimed at the end high comes with higher prices. Pricing has a direct impact on our sales and the quality perception of our products. We have decided our price level according to several factors to place ourselves above our competitors. The price takes into account the product quality and the customers as a higher perceived quality, but also to be more profitable because investments to increase the quality and number of models are expensive. However, with the competition and our market share, we had to readjust and downgrade our prices several times to remain competitive, as for year 13 and for year 15. Our commercial strategy was based on a strong marketing and advertising budget. We have really relied heavily on celebrities and their attractiveness in a vision of marketing pool to make our products very visible and gain market share. On the internet segment, we applied the same principle as in the wholesale segment with a stroke full price that does not cannibalize this segment. We followed a slight geographic price strategy, that is to say a price fixing according to geographical areas, a little more expensive in North America and Europe, Africa, than in Latin America and Asia Pacific. For the year 15, we adopt a psychological price strategy. Instead of rounding, we propose a price to the lowest cent. We did not opt for free shipping so as not to incur additional costs, not to make internet sales at the expense of wholesale sales, and to remain on a quality image.
During the first year, we tried to be part of the private label, but we saw that it was not the most attractive market for our strategy. The margins were much lower than the wholesales, and it was kind of random. Rapidly, after the first year, we decided to move away from this type of market. Our strategy consisted to gradually drop out to be sure that we won't miss a potential market. After the fourth year, we completely stopped the private label. We decided only for 1 year to sell our overproduction in the private label market to get our inventory moved.
And now we're going to talk about our production strategy. For the years 11 and 12, we had 2 major plants in North America and Asia Pacific. The one in North America would be able to produce 2,000 in regular and 400 in overtime. And we chose this option because of the high celebrity appeal that we had over there. Whereas the Asia Pacific plant would be able to produce even more with 4,000 regular and 800 overtime, and that was mainly due to the low production and labor costs. In year 13, we opted for a new plant capacity in Europe and Africa. And so we invested in a plant that could produce 1,000 regular plus 200 in overtime. As for our training, we also trained our workforce in all of our plants in year 13 in order to increase the quality of our product, and it was the cheapest way to do that.
So now we talk about our financial strategy and how it has been adapted according to our situation. So at the beginning, the strategy was to opt for a differentiation strategy, so to invest all our free cash flow in the development of the structure and our assets. But in year 14, there has been a financial disaster, and Thomas will explain you later. Our return on equity and earnings per share were very, very low. So we decided to change our financial strategy, to opt for a restructuring strategy. And what we did, in year 15, we bought our share in order to increase our return on equity and our earnings per share. And in year 16, we continued this strategy. We also decided to pay a dividend. We know that will have reduced our stock price, but we also thought that the increase of our return on equity and our earnings per share will allow us to catch up this decrease. It was happened because our stock price increased by an important percentage. But what is now our current strategy? So now that we have a stable financial strategy and we expect to increase our revenue and profit, Kamal will explain you later, we'll think that we'll maximize our free cash flow. That will allow us to increase also the value of our company by the method of discounted free cash flow. That will also increase our stock price.
As the private label segment was too volatile and unpredictable, we decided to stay sustainably on the internet market and wholesale market. On the internet market, our main competitor was Blake. In the beginning, we opted for differentiation strategy with high quality and high prices. However, Blake was able to offer similar or even better quality for a lower price. This explains that they owned more market share than us, especially from 2013. This made us decrease drastically our prices, first in year 13, then in year 15, maintaining the same high quality. Consequently, we reversed the trend to own more market shares than our competitor in 2015 and 2016. On the wholesale market, our main competitor was also Blake. Nevertheless, while they had better quality, our prices were quite close, just as our market shares. We still reduced our prices below theirs in North America and Asia Pacific to ensure an advantage position on the segment.
As for our long-term goals, after beating our main competitor for the past years, Blake, our aim is to topple the market leader, C Company. In order to beat Blake, our strategy was to lower our prices since quality does not necessarily imply higher costs if well managed. For the next 2 years, we will be investing in a new plant in Latin America, all while expanding our model range to 350. In the graph below, you can see the impact of the previous increase in model ranges from year 14 to year 15, which was from 200 models to 250 models. We saw the strong impact it had on our revenue and on our profit margin, and we expect the same impact even stronger since we will be increasing even more. On the long term, we will also contemplate the idea of shutting down our North America plant and increasing the capacity of our Asia plant due to cost reduction reasons.
We have learned a variety of things. First, it is important to have a clear vision of what you want to be in the next few years. We wanted to be a strong, well-known brand recognized for its high quality. We have tried to be as coherent as possible to this, even if we understood that many factors can impact this idea. Second, even if we choose a differentiation strategy from the very start, we understood that we had not only to be reactive, but proactive in order to remain on the market. This requires many concessions, especially in terms of pricing. This brings us to our third point. A strategy is meant to be adaptive. To be competitive, you should not only know your overall strengths, but also your environment and competitors. Fourth, we made mistakes and took some bold risks, but sometimes we need to trust the process, believe in the company and its competitive advantages to achieve success. To finish, a company is not only about making a product and making profit out of it. When we start, we were more focused about the price and number of models. But it was also about the workforce, the image rating, etc. This definitely opened our eyes to how complex any product can get.